Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of October 2nd. Big news last week. The government averted a shutdown with a last-minute deal reached on Saturday night. The government is now funded through November 17th. So turning to this week, the most important data point this week is Friday's payroll report. It's one of the first looks at last month's economy. So what I'll do is discuss what is expected and why we feel payrolls are likely going to come in a little bit better than expected. So first of all, the consensus. The consensus for September expects 155,000 jobs. This is down a bit from August, 187,000 jobs. If you look at this chart here, this chart shows that September should continue the downtrend in terms of job creation and mark the fourth month in a row that jobs have come in below 200,000. The unemployment rate should decline a bit from 3.8% to 3.7%, but wage growth should pick up a little bit from 0.2% to 0.3%. So with all this said, though, what do we expect? We expect non-farm payrolls to be a little bit better than expected. First, as you see here, jobless claims continue to fall week by week, and especially this is seen in September readings. Second of all, on September 22nd, S&P Market released its composite PMIs, and these are basically estimates of September's economy. One thing in particular, they said that U.S. businesses registered greater hiring activity during the month of September. And quote, the rate of job creation quickened to its fastest pace since May. So we do think jobs are going to come in a little bit higher than expected for September. Wage growth should also continue to slow down a bit. The economy is slowing. And if you look here at this chart, quit rates are falling. So this puts less pressure to increase wages. So the overall big takeaway this week is that markets will be watching the payroll report. It's a first look, or one of the first looks at September's economy. The markets are going to gauge how quickly is the Fed slowing the economy down and any increased inflation pressures or threats. Higher wages or labor strength would put pressure on the Fed to raise rates more than the markets anticipate. The good news is that while we expect the labor market to be a little stronger than expected, wage growth should be kept in check. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and see you next week. Thank you.